Palantir has officially moved from a controversial software company to the undisputed backbone of the global AI economy. It is early February 2026, and the financial world is still reeling from what many are calling the most significant earnings report in the enterprise software sector. For years, skeptics labeled Palantir as a black box government contractor, but today, the numbers tell a completely different story. We are witnessing an unprecedented acceleration in commercial adoption that is defying every traditional law of software scaling. But with the stock price reacting violently to these new figures, the question remains, is this the start of a new parabolic run, or is the valuation finally reaching a breaking point? Let's break it down. We have to start with the breaking news from this week. Palantir didn't just beat expectations, they absolutely crushed them. The fourth quarter 2025 results were historic, and the 2026 guidance has sent shockwaves through Wall Street. Beyond the numbers, the strategic momentum is undeniable. This week, Palantir confirmed a massive new partnership with Cognizant to accelerate AI-driven modernization across healthcare and enterprise operations. Furthermore, Sovereign AI has selected Palantir to help build the next generation of AI infrastructure across EMEA, while the group-wide strategic partnership with HD Hyundai continues to expand. This is no longer just about data analytics, it is about providing the operating system for modern civilization. Let's dive into the fundamental analysis, because the data from the 2026 reports is staggering. Total revenue for the full year 2025 grew 56% to $4.48 billion. However, look at the quarterly acceleration. Fourth quarter revenue hit $1.41 billion, a 70% increase year over year. This surge is being driven by the U.S. commercial sector, which grew by an incredible 137% in the final quarter alone. For the full year 2026, management is now guiding for total revenue between $7.18 and $7.2 billion, crushing consensus expectations. Perhaps even more impressive is Palantir's profitability machine. The company is generating massive amounts of cash, with cash from operations hitting $2.13 billion for 2025. The GAAP net income for the fourth quarter reached $609 million. But look at the operating efficiency. The adjusted operating margin has surged to a record 57%. This has pushed their Rule of 40 score to a legendary 127%. In the world of software, anything over 40 is considered elite. At 127%, Palantir is quite literally in a league of its own. They ended the period with $7.2 billion in cash and zero debt, giving them the ultimate war chest to out-innovate any competitor. Now, let's translate these massive fundamentals into the technical analysis. Despite the record-breaking earnings, the stock chart shows a complex battle between bulls and bears. After a monster rally in 2025, the stock has recently been consolidating. Technically, we are looking at a critical junction. The primary support zone to watch is between $142 and $148. As long as the stock holds above this level, the long-term bullish structure remains intact. On the upside, we have heavy resistance near the $180 to $190 range. If Palantir can clear that $190 hurdle, the path toward a long-term target zone between $230 and $260 by late 2026 remains wide open. However, caution is warranted. With the forward price-to-earnings ratio sitting near 140, the valuation remains a high-stakes bet on perfect execution. In conclusion, Palantir is no longer a speculative play, it is a fundamental pillar of the digital age. The numbers they are putting up are rare, and the 2026 guidance suggests the AI tailwind is only getting stronger. My final advice? For long-term investors, the current consolidation represents a strategic accumulation zone, provided you can handle the high multiple volatility. For short-term traders, wait for a confirmed breakout above $180 before chasing the next leg up. But I want to hear from you. With a $7.2 billion revenue target on the horizon, do you think Palantir is still undervalued, or is the triple PE ratio too much to stomach? Are you buying the post-earnings volatility or waiting for a deeper retest? Let me know your moves in the